Good evening, guys. Okay, Friday night, and I thought I'd give you another one of the Finance University lessons here. You guys asked for them, wanted me to make this a series, so I thought I'd do it. And I know some of the stuff I'm going to start with here is very basic, but I mean, we talked about APR and APY the other day, and a lot of you guys were like, thank you for explaining the difference. I want to talk about a real basic one that pretty much, I'd say 3/4 of the people in the country participate in. And this is retirement plans, okay? So whether it's your 401k or a 403b or a simple IRA or a SEP IRA or whatever, these are all different tax codes that are in there, okay? The most common one is 401k, so I'm going to talk about that. These are all defined contribution plans as opposed to defined benefit plans. Defined benefit plans are pension plans, right? And again, if you think about it, you work here for 20 years, you're going to get 50% of your salary for the rest of your life. Defined benefit. Defined contribution, which most of us are participating in anymore, those started back, well, the law was actually passed in 1978. And in 1980, defined contribution plans, the 401k, which is actually, the way it's got its name, it's a line of tax code. Okay, that's what it is. It's not like somebody came up with anything crazy. It's line 401 parentheses K. And it's just taken on a name as to what 401k is. But I wanted to talk about something that I get in emails from you guys. I remember hearing from clients. I've talked to people all over the place throughout my life about my 401k. Should I sell my 401k? Should I put my 401k in something safer? This is what you need to understand, and I'm going to try to explain it as best I can here. A 401k is not, repeat, not an investment. It is a vehicle. And the best way I've ever been able to explain this to people is think about going to the grocery store. You buy your bananas and your ground beef and your milk or whatever it is. You go up, you pay for it. They put it all in a bag. The 401k is the bag. The milk, the bananas, the ground beef are the investments. You can't sell a 401k. You can't, a 401k isn't risky. It's the investments that are in them. That's the difference. Now, if you're worried about market volatility, God knows we've seen that this week, okay? Believe it or not, this will shock you, but as of here Friday morning when I'm recording this is actually the best week the market has seen all year. Surprising with all the ups and downs we've had, okay? Going into this morning's open, the market was up the S&P was up 3.8% for the week. That's a great return, okay, for a week. Doesn't mean that's the way the day's going to close, the week's going to close, the month, the year, whatever, okay? But we've seen a lot of volatility. It's been the talk of the town everywhere. I bet people have said, oh my God, my 401k. It's the investments in it. Now, if you have a defined contribution plan, the company chose what your investment options are. Maybe you have your 401k through your employer, okay, but it's a Fidelity 401k, or it's a Vanguard 401k, or whomever. And the investments, the options that you have in there, that's where you're assessing what your risk is going to be. You've probably got large cap growth, a large cap value, maybe a couple of different bond funds. You've got an international fund in there. You've got a money market fund in there, et cetera, et cetera, et cetera. Okay. That's your standard defined contribution. Maybe there's a small cap growth in there. Okay. Usually you'll have 6, 8, 10 choices to pick, to allocate your money to. I want to put 20% in this, 10% in this, yada, yada, yada. That's where you're taking your risk. Okay. If you want the least risky of it all, you're going to put it in money market funds. Okay. I mean, that's basically like a savings account. You're not going to have any risk, but you're going to get nothing in a return. Okay. You know, money market rates, depending on what they are, maybe you're lucky you get a 2, 3, 4, 5%. And again, they all fluctuate. So you're trying to keep up with inflation. That's it. Okay. It's like a savings account. You want to go into riskier, well, that, your most risky is going to be international. As I talked to you guys a week or so ago, not only are you dealing with market risk, what the underlying stocks do, but you're also dealing with currency risk, because what is the exchange rate between dollars and yen, dollars and pound, dollars and won, whatever it would be, okay, Forex, foreign exchange. And somewhere in between, whether there's bond funds or small cap is going to be more volatile than large cap, et cetera, et cetera, et cetera. That's where you're taking your risk. If you're worried about risk, take a look in the plan and see what the volatility is. Just go look at what the returns are. And I mean, again, any mutual fund, any broker will tell you past performance is no guarantee of future results. But look at the swings. Oh my God, it was up 40% last year, but it was down 30% the year before. Okay. As opposed, it was up 10% last year, but it was down 6%. Less volatility means less risk. Okay. This is what's important to know. Now, you could be very conservative, being in money market fund, and you could still make a boatload of money in your 401k. And this is the one thing that used to drive me insane when I'd hear people say, I'm not participating in my 401k. If I walked up to you on the street and said, here's $20, would you take it? Or would you say, no, thanks, I don't want it? Okay. Company matches are free money, guys. Oh, yeah, sure, I understand. They got 4 or 5 year vesting. You can't touch the money. But you get the market appreciation or the interest or the dividend or whatever it is on those company contributions. You can't take it out. But if you're not retiring for 5 years, who cares? Okay? Gee, I'm getting 2%, but the company's matching me dollar for dollar or giving me 50 cents for every dollar I put in. That's free money. You put in $100, the company puts in $50, you've got $150, and you're getting the returns on it. Okay, unless the market goes down 33%, which at that point we got bigger problems, you still have your $100. The money you put in, plus whatever they gave you. So don't ever go, gee, I can't do it. Even if you were the most conservative person in the world, still participate. I don't believe in the stock market. Do you believe in free money? Okay, you can do money market fund. If you're really close to retirement age, might be a good idea. You want to be risk averse. You don't want to risk losing a lot of money. I'm there. I'm very risk averse. That's why I've told you about Philip Morris or Ford that I own. There's not a lot of volatility in there, but they pay a good dividend. Just giving you my example. I'm not telling you to go buy anything. But that's the most important thing to take away from this is your 401k or your SEP IRA, or your simple IRA, or whatever. Those are retirement plans, okay? It's very different from a traditional IRA or a regular IRA. It's just what the name is not an investment. It's a vehicle. It's the grocery bag that you're putting all the investments in. Now, the next part of this is, do you have a 401k plan at an old employer? gee, I used to work for, I don't know, pick something, Bed Bath & Beyond, and I had a 401k plan there. And the company went bankrupt. Your 401k did not go bankrupt with it. Okay, that was somewhere else. Okay, maybe you lost the money that you had invested in company stock, but anything else you had is still there. Do not leave it there. What you do is called a rollover. And you can roll it over into either a traditional IRA, individual retirement account, or a Roth IRA. Okay, so herein lies the question. The difference between a Roth IRA and a traditional IRA. And both of them get you tax-free growth. Well, they're invested. You can make any changes you need. There's no capital gains tax while you're invested, et cetera, et cetera, et cetera. But the biggest difference is when the money's taxed. And this is what you need to figure out, okay? Because contributions to a Roth IRA, you want to put money in now. You're 50 years old. You want to put money in now. Contributions to a Roth IRA are made with after-tax dollars. Means you've already paid the tax on it, okay? So when you withdraw it, you're not paying the taxes. Contributions to a traditional IRA are made with pre-tax dollars. So means you're going to pay the taxes when you take the money out. Do I want to pay taxes now? Do I want to pay taxes then? And a lot of people will jump right out and say, oh, you want to pay the taxes when you retire. Or other people say, oh, you want to pay the taxes now. Okay. There's no tax implications on converting or rolling over a 401k into an IRA. There's no tax implications on rolling a Roth 401k into a Roth IRA. If you want to crisscross, then you've got a tax issue. Okay, and that's something that, unless you're very familiar with how taxes work, you at least want to talk to your mutual fund company that you're rolling it into, or your brokerage firm, or wherever, but preferably an accountant. Okay. But what you have to figure is this: what's your tax bracket now versus what do you think your tax bracket is going to be in the future? And granted, none of us know what the IRS is going to do 5, 10, 15, 20 years from now. Okay, so I'm going to give you this. So you're going on something that's guaranteed what your tax bracket is now versus something that's up in the air. Things to look at. Right? Most people will be at a lower tax bracket when they retire than when they're working. Because if you're making, let's say, $100,000 a year, okay, just make math easy. Unless you have $1 million saved and you're getting a 10%, you're taking 10% out of your money per year when you retire, your income is going to be lower in retirement. Okay? And again, this is what we look at our graduated tax brackets. It may be a situation where you're in the 22% tax bracket now, but when you retire, based on what you figure your income needs are going to be, what you're going to take out, you may be in the 10% tax bracket. Those are things to consider. Saving for retirement is important, okay? Unless you plan on working until the day they put you in a pine box, saving money is always good. Remember to do it smartly. Educate yourself a little bit on the differences. But again, the most important thing I want everybody to remember is a 401k is not in itself an investment. An IRA is not in itself an investment. It's the vehicle in which the investments reside. Remember that. It's probably one of the most common things I've ever heard during my days as a broker, afterwards, and people say, oh, my 401k, I've got to get out, it's too risky. No, 401k isn't risky at all. It's the investments you have in it. But like I said, think of it like a grocery bag. It's just what's holding it. It's what's inside that you got to concern yourself with. And there's another one for you. Very basic, okay, but it's a mistake people think about all the time. Just kind of wanted to inform you. I'll keep giving you more. If you've got suggestions on things you want me to talk about, that's how the yield one came up in the first place. I'm more than happy to explain it to you. Have a good weekend, guys. Pinball out.